Okay, so class number 3. So tonight we're going to cover a few topics. We're going to keep on going in our series of 10 steps to get the provision completed. And tonight we're going to focus on step 4 for starters. And we're going to make our way through step 5 and 6 as well. Okay? So we're going to work a lot on deferred taxes today, and we're also going to introduce the concept of state taxes separate from federal taxes. So we'll get kind of the multi-jurisdictional thing in the problems that we do. Okay? So tonight when we go through the materials, you'll see there's 2 in-class problems. Though they're going to be more like half-an-hour type problems as opposed to the quicker problems we did before. And we're going to do the same sort of thing where you work together in groups, and then we'll go through it. But the problems will get more complicated, like I said, by email. Okay. So I'm going to blow through pretty quickly some of the set material for this for tonight, because I want to make sure we spend lots of time on the problems. The problems will be where you kind of reach a conclusion as to how you're doing so far with grasping the concepts. Okay, so we're going to start with step 5 tonight, which is accounting for uncertainties. And this again is, so the terminology here is a little confusing, but when we talk about uncertainties, this is where you'll see the term unrecognized tax benefits. And an unrecognized tax benefit is synonymous with reserves, or the liabilities I book for my exposures. So these are taxes incremental to what I put on my return, but taxes that I might end up paying if I'm audited by a taxing authority. Okay? And when we talk about this topic, it's a global issue. So like Lee was saying in her presentation, I think she said they have like 45 countries that they do business in, I think is what she said. And so in each of them, they evaluate the need for uncertainties, right? Do they have exposures in country A, B, C, D, E, right? I mean, that's a common situation. So you guys are learning the topic now, and so the rules that are in place currently are kind of just the rules to you. But it's important to understand kind of what the history on this topic was, because as you go work with a firm or with a company, most people that are 30 and up will know the old rules, at least have that as context. And it's kind of important to know that, because the difference between old rules and new rules, big difference. Okay? So as you can see on this slide, before 2007 was the effective date of FIN 48. And before FIN 48, there was practically no FASB guidance on how a company should account for an exposure. And companies would revert to what was then called FAS 5. And FAS 5 was kind of the overarching guidance for a company's entire financial statements whenever there was an exposure. So it could be a sales tax exposure, it could be a company is being sued by a disgruntled employee, and so there could be some kind of legal exposure. A company could have dumped some waste into the ground, and there could be some environmental exposure. Like all those loss contingencies were governed by FAS 5. And what FAS 5 basically said in one sentence was, if you have a loss that is probable, you accrue it. That's it. And so people kind of, there's a lot of hand-wringing around what a probable loss is. Like, what does the term probable mean? And when you look kind of deeper in the accounting guidance for help, the definition of probable was likely. And that didn't really clear it up for people either. And so what people observed out of that old FAS 5 practice was that companies were all over the map, right? You could have the same facts with 3 companies. You know, some would accrue no reserves, some would accrue lots of reserves, some would accrue some reserves, some would disclose something to a reader of a financial statements. but the norm was to not say anything in the financial statements. Like, it used to be very common that before FIN 48, you would see no mention of any exposures or reserves in a tax footnote. Or there would be a statement that basically says the company thinks they're adequately reserved. And that's it. So you don't know if they're adequately reserved to the tune of $189 million, like, you know, with Lee's company, or adequately reserved to the tune of $5 million. You just don't know. And so FIN 48 came out, and FIN 48 was the guidance pre-ASC 740. And so when everything went to the ASC format, all the old accounting guidance got integrated, and so it's all in one place now. But before ASC 740, it was FAS 109. That was accounting for income taxes. And FIN 48 was an interpretation of FAS 109. So a FIN is a financial interpretation. Okay? And the interesting thing is, you went from a one sentence, if the loss is probable, you accrue it sort of guidance, to FIN 48. And I should have brought my book, but I have a copy of FIN 48 when it came out, and it's probably 100, 150 pages long. So you went from one sentence to like a big book of rules. And all the companies kind of threw up their arms and are like, this is crazy, you know, this is so much volume, there's so many requirements here, this is creating a lot of, this is putting a lot of compliance burdens on companies with all these new rules. And but FIN 48 just changed the way companies work in terms of accounting for exposures now. And so what you see is, you see a lot more documentation to satisfy all the requirements in FIN 48. So one of the things we should have asked Lee is, you know, the volume of work that they do around FIN 48. It's a lot. They write up memos, they have all sorts of calculation work papers to track all their different positions that have uncertainties to them. And then the other really significant thing is now every company has a whole section of their tax footnote that pertains to disclosures of unrecognized tax benefits. And that is completely new. And when FIN 48 came out, it was paragraph 21 that spelled out, like an A, B, C, D, E, F, all the disclosure requirements. And those disclosure requirements are pretty comprehensive, or at least they're a lot more than what a company typically wants to say in a public document about their tax reserves, right? So remember, when a guy like Eugene, when he was working at the FTB, when he would read a company's financial statements in 2005, all he would see is a statement that says, I think I'm reserved adequately. And so for Eugene, that's not a lot to go on. Right? But now, you know, he looks at the financial statements and he sees, oh, I got 189 million reserved. Right? So, you know, you might take away from that this company's somewhat aggressive and they have a lot of reserves out there. And so maybe I should take a closer look. Right? And in that FIN 48 disclosure, you know, sometimes there are jurisdictional specific comments, and boy, that can really be an audit trail for the taxing authorities, right? So there's a delicate balance there between informing the reader and making sure the reader understands what the company's doing and what its liabilities are and what its risks are, and then also informing your tax authority, right? So that's the tension that FIN 48 created. So the basic rules for uncertain positions. So the way FIN 48 works, and again, this is now in 740-10, the way this works is you're supposed to categorize all your positions that are other than highly certain. So if you think of everything you do on your tax returns, there's things that you do that are highly certain, like you deduct somebody's wages. You know, Lee works at a company, they pay her a wage, the company deducts it. That's highly certain, right? There's like nothing to that in terms of anything that is uncertain about how the tax law applies to that salary deduction. And then there's a whole other pool of deductions or positions that have a level of uncertainty to them. Right? So you claim an R&D credit. Well, it's not really clear like how much credit you should claim because it's not really clear, you know, what qualifying wages are. Or if you have transfer pricing between related entities, that's always uncertain because it's a really gray area, right? You're not sure. Or if you take a 199 deduction, for example, that's the manufacturer's domestic manufacturing deduction. It's not really clear how to compute that deduction with respect to which profits are qualifying, because it's profits that drive the deduction. And so there's uncertainty there. So the idea is you're supposed to pool all the positions that you have some uncertainty and then go through a series of steps that FIN 48 calls for in terms of tests. Okay? And so there's two main tests. The first test is what's called the recognition test. This is the second bullet here. And what the recognition test says is, again, you're taking the second pool that I just described. You're taking the pool of positions that have some level of meaningful uncertainty to them. Okay? And the bar there is low, right? If there's really any uncertainty, you're going to go through these next steps. So the first step is a recognition step. And what it basically says is, you got to look at a tax position and determine whether, if you went to court on it, you're at least 50.1% likely of winning the position. Okay? So the question is the position you took on just the basis of technical merits, is it a winner? Right? Are you more likely than not to succeed just on technical merits? And the important thing about this test is that if you're not, then you don't take any benefit in your provision for that position. Okay? So one of the FASB rules was, boy, if you're an aggressive taxpayer, so aggressive that you're on the south side of even a 50% chance of winning, you shouldn't even book any provision benefit, no financial statement benefit for those aggressive positions. Rather, you should just wait and see what happens in an audit, and if you ultimately win, you can book the benefit then. Okay? So again, they took this subjectivity out of a company's hands of what's a probable loss, and they said, look, you got to make a conclusion on the technical merits for a position, and if you're not at least 50.1%, then we're not even going to get into the how much are you going to lose or settle or fight out with the tax authority. We're just going to say don't book any benefit. Okay? If you pass the recognition test, if you decide, look, I looked at my position and I think I'm more likely than not to win just based on the technical merits, then you go to the measurement test. Okay? And we'll talk about this in a lot more detail when we get to the following slides. But the measurement test, what it basically says is, if you have a position, like let's take the R&D credit as the example. If you have a position that you're more likely than not to win on the technical merits, the goal of the measurement test is to figure out how much of the position you're ultimately going to book as a benefit. Okay? So if you claim an R&D credit on your tax return of 100, and you say, I'm more likely than not to win. If I went to court, I would win on this. But people don't litigate every position that they take on their return, right? In fact, very few people litigate any position. So the point of the measurement test is, if you're audited, where are you going to end up with a examining agent or in appeals, right? There's going to be some sort of settlement usually on positions that are gray, like a transfer pricing or an R&D credit. And so you often are trying to measure the amount of the benefit of a position that you've put on your return, how much of that you're going to keep, right? So how much of the $100 R&D credit I claimed, how much of that am I going to keep? Am I going to keep 70 or 80 or 40? That's the purpose of the measurement test. Okay? In general, you'll see UTBs on the balance sheet as a FIN 48 liability. So oftentimes when we look for, and I think I pointed this out with one of the 10K examples, oftentimes you'll see a company's balance sheet has a line called non-current tax liabilities. And non-current tax liabilities is your cue to know that's a tax reserve. Okay? And usually it's in non-current because the definition of what's current or non-current is dependent on when you expect to pay it. Okay, in most companies, because it takes so long to get audited, so long to identify the issue, go through the examination process, it's very typical that these reserves are in the non-current section. Okay? And when you think of kind of what a position is just about anything. I mean, it's the deductions you claim, it's the income you exempt, it's the filing of a return, right? Like if you're a company and you're doing business in Oregon, but you don't feel like filing an Oregon tax return because just you don't feel like paying Oregon tax, that's a position, right? And you would evaluate that position on a FIN 48 basis. So a lot of times, whether you have a filing requirement in a state, that's subjective, right? And so it's very common to have reserves for states that you don't file tax returns in. Typical issue. Okay, so let me just pause there. So basics of FIN 48. Making sense so far? Okay, so these are basically our steps to applying FIN 48. Okay, so we're going to identify the position, figure out if we pass or fail the recognition test, go on to measurement, and then after that we have a series of 3 other mechanical steps in terms of what to do on the balance sheet. Okay. So I'm going to skip the identifying a position discussion and hop right to the recognition step. So, like I was saying, I mean, there's really 2 key steps in the process of evaluating uncertain positions. And when you go to this recognition step, the thing that I want to add incrementally to what I already said was the bullets that are on the right-hand side of the slide. So FIN 48 was explicit on the assumptions you can use in determining whether you pass or fail the recognition test. Because the number one question that people would ask pre-FIN 48 is, can I include my audit detection probability into the equation? So if somebody says, do you have a probable loss? Well, then the response might be, I don't even think I'm going to get audited. Or if I'm going to get audited, I don't think the agency's even going to find it. Right? And so the FASB doesn't want companies accounting on their financial statements based upon whether you think you're going to get caught. Right? I'm sure you can appreciate as a potential investor, like that's not a great standard for accounting for potential contingencies. Right? And you can see how the personal subjectivity of that is not a good thing. So the first bullet on here is, they clarified it and they put that question to rest and they said, no, you have to assume you're going to be examined. And you have to assume the examiner will have all the relevant information about the facts. Okay? So those 2 steps or assumptions, that's a wild change from what people were doing pre-FIN 48. Right? Because in reality, you're not always going to get audited. And almost always the taxing authority is not going to have all the relevant information. Right? Because the way tax exams work, they ask questions, you answer them. It's not that they ask you to tell you everything they want to know and you tell them everything they want to know. That's not how it works. So, so those 2 first bullets, I mean, that's a bit of a exaggerated reality, but that's the way that you're supposed to apply FIN 48. Okay? The third bullet, so if you have 2 positions and you think you might win one, lose one, and you think you're going to horse trade and get out of an audit by, kind of playing it loose like that with an agent, which oftentimes is kind of how things work, FIN 48 said, no, you can't do that. You got to look at every position individually. You got to look at your R&D credit separate from your DMD deduction, separate from your transfer pricing, and you have to evaluate each of them in terms of what's going to happen. Okay? So again, that's another departure from what happens in the real world to a large extent. Thank you. Okay, so good question. So let me give you an example of what Vicky's getting at. So let's say that you have a transfer pricing issue between the U.S. and the U.K. Okay? So in the U.S., the tax rate's 35%. In the U.K., it's like 25%, roughly. Okay? So if the U.S. came in and said, you know what, we should probably have $100 more income in the U.S., then in theory, your next response is going to be, all right, well, I guess I get a $100 deduction in the U.K., right? Because it's a zero-sum game. And there's a process that the IRS and a lot of foreign governments have called competent authority to reach that kind of equal and fair result. where the IRS and the equivalent of the IRS in the UK get together and they kind of agree on what a fair adjustment to the related party transfer price is. And so you would pick up your $100 of income in the US possibly, but then in turn you would get a $100 deduction in the UK. So what's interesting about that is because the tax rate differential is only 10% in that example, there's really only a $10 risk from an exposure perspective to the financial statements, right? Assuming both companies are taxpayers and profitable and all that. The way you account for that is you accrue a 35 liability in the US and you accrue a $25 DTA in the UK. So remember in the table we were looking at with Lee's company, they had that 189 million total, but then they said only 118 affects their rate. The way that table works, you would include the 35 in my transfer pricing example. So even though your real economic risk is only 10, the table includes gross liabilities, not net of offsetting benefits. So when Lee said my table shows 189 but only 118 affect my effective tax rate, that's very similar to this example where you have a 35 liability, but if everything went away and you had no adjustment, there's only 10 that affects your tax rate. So that's the kind of situation where the table is a little misleading in terms of what your real economic liability is. I know that was kind of a lot to follow, but hopefully that made sense. That makes sense at least to you, Vicki? Okay, in the recognition step, this is the second to last bullet on the right. You're supposed to look just at technical merits. Okay? And that's important because if, let's say Lee said that her company is a Deloitte audit client. So let's say Lee takes a position on a return, she deducts something, we're her auditor, and she says, I think I passed the recognition test. It's more likely than not, right? And we might say, no, we don't agree. We think we're going to lose, right? People debate like the merits for a technical position all the time. So this one's tricky because in theory, this one is predicated on you're looking just at tax authorities as if you're going to litigate the position. But for aggressive positions where you might be towing the line on the 50%, it's not a simple matter of a company concluding. I mean, the auditor has to agree with this. And so that created a lot of friction on the front end of FIN 48. I mean, I would say that's much less of an issue these days, just because of the maturing process of FIN 48. But that was definitely one friction point when FIN 48 first came out. Because companies started thinking I had to get opinions for my various transactions, and it was a big deal to try to pass this test and agree on that conclusion. So that's the recognition test. Most positions that companies reserve for are these kind of gray subjective things where, as a technical matter, you pass the recognition test, and all the FIN 48 thrash occurs in the next step, the measurement step. Okay? The exception would be if you basically are not filing in a state, you know you have a filing requirement, you fail the recognition test, right? You have to accrue the entire reserve, that the entire tax you saved by not filing, you have to accrue for it. Or if you take a position that is clearly aggressive, below the 50%, but for whatever reason you do that, it's just the volume of those is less than the volume of transactions you see that move on to the measurement test. Okay, so the measurement test. So let's go kind of right to left on this slide. So here again, the slide's formatted in the same way as the prior slide where we have the assumptions down the right. So the first 3 bullets are the same as the last slide. Okay. But the last 2 bullets are different. Okay. So the second to last bullet is one of the more interesting ones because it says you should base your measurement of the position on all the relevant facts. Okay. All the relevant facts is pretty interesting because it could be a function of how good of a negotiator you are. It could be a function of your relationship with your taxing authority. Like maybe you guys get along and you quickly agree on things, or maybe you hate each other and that agent's going to just stick it to you just to be punish you. It could depend on whether you think the taxing authority is ever going to really understand and be able to articulate their view of the position, like whether they're actually capable of making the assessment. Again, there's no audit detection risk per se, but if you think you're so overpowering compared to the tax authority, which is often the case, I mean, those kinds of things factor into this. So what you're really getting at is, gosh, as a practical matter, where am I going to end up if I'm in a dispute with the tax authority? And if you think of all the things that are part of that dynamic, some of those like soft issues play into that, right? That's very typical. So here's the way, so if we focus on the left, here's the way that FIN 48 is drafted. And this is really an interesting academic way of looking at things. So here's the rule. The rule is you book a position, you book a benefit at the largest amount that is greater than 50% likely of being realized. And that is on a cumulative probability basis. Okay? And this is wild. I mean, I think before FIN 48, if you asked somebody what the definition of cumulative probability was, most people wouldn't really know what you're talking about. But FIN 48 kind of put that term on the map for tax accountants. And the best way to explain it is by looking at an example, which is what the table at the bottom left is for. So what you're supposed to do is, so take my R&D credit example. You're supposed to identify all the possible outcomes, right, which is what this is. So there's a chance that I could be audited and I would keep my whole credit of 100 I put on my return. There's a chance I'm audited, they make an assessment, we settle, I keep 80, right, and then 60, 40, 20. So those hypothetical outcomes are just made up for purposes of the illustration. But the idea is you're supposed to identify the possible outcomes. Like what could happen? You could win, you could lose, you could settle in the middle, you could settle somewhere else. Those are the outcomes of a tax exam. So that's step one, is to identify the possible outcomes. Step two is to assign an individual probability to each outcome. And that's what the second column is. So this is saying there's a 15% chance of me winning all my credit. There's a 20% chance of me winning $80 of my credit, right? And so on. Individual probability. Okay, so that part's easy probably so far. So then the third column is cumulative probability. And what that means is, if you focus on the 80 row, the probability of you getting at least $80 of credits has got to be the sum of the probability of you getting both the $80 outcome and the $100 outcome. Right? Because if you define it as the probability of getting at least 80, it has to include the 80 scenario and anything above it. Right? So if you add up the two individual probabilities for the 100 and the 80, that's 35. And so the chance of getting 35 at the end of the day, the chance of getting 80 at the end of the day is 35%, right? Because you might get 80, you might get more, but cumulatively the chance of getting at least 80 is 35%. So you're supposed to go through those mechanics for a position, and the first outcome you get to, where the third column is more than 50%, that's the scenario you book to. Okay? So in this example, you would book $60 of credit, and in turn, you would end up with a $40 liability on your balance sheet to offset the $100 credit you put through your return. Okay? So what you might be thinking is, if the idea behind FIN 48 was to take out like that subjectivity out of kind of a what is a probable loss, you're probably thinking, well, this table can be gamed in a lot of ways in terms of both identifying the outcomes, because it's kind of up to you to identify what the outcomes are, And then more importantly, assigning that individual probability, right? Like if you didn't like that 60 result, you could change the middle column and then get a different result. So that's one of the flaws with Fin 48 is there's still a lot of subjectivity in terms of how people define the outcomes and how they assign probability to them, because there's a lot of judgment with this. And if you look at that paragraph in the bottom right-hand corner, it basically says the conclusion should be based upon what a company would ultimately accept in a negotiated settlement. Right? So that means it's really company specific in terms of what their judgment is. Right? Some companies give up easily and say, you know what, I don't want a protracted audit. I don't want to waste my time fighting with the tax authority. I don't have the tax department to do that. I don't want to be in the newspaper for litigating, against the IRS. I just want to kind of move on with my business. So that company might accept one settlement that's different from the company that's just, I have principles, I'm not bending on him, I'm John Boehner, we're not having a vote, right? Like, you see kind of how the differences in perspectives will dictate kind of where you end up on settlement talks. And then the same is true for Fin 48, right? Okay, so that's recognition and measurement. In theory, for any position that if there's some sort of meaningful uncertainty, you're supposed to go through those two steps, document the two steps. Why do you pass recognition? And then how did you conclude on measurement? And it's pretty common that companies will do a little table like this one in the lower left corner as part of their documentation. It's not required, but it's common with Fin 48. Wait. Good question. I mean, if you're talking specifically about the measurement part, it's a good question because what most people thought you did before Fin 48 was you accrued almost to like a best estimate, which is kind of how a lot of foreign countries deal with the equivalent of Fin 48. Is they tell you to accrue whatever you think the most likely outcome is. And there's not this like come up with a bunch of scenarios and do this cumulative probability thing or even the averaging thing. They just say, pick what you think the most likely thing is to happen and account for it that way. And that seems actually really logical, right? But I think the idea here was to create a framework so that where a lot of outcomes are possible, you've created a framework that will allow consistent application of the rules between companies with similar positions. That's the idea. But again, the reason I said it was very academic is no one would have ever gone through this exercise pre-Fin 48 to try to assess what to accrue in their financial statements. Like it would have never occurred to somebody to take all their outcomes and put probabilities against them. That's just not how it works. Vicki? Okay, so Vicki's question was, what if you go through these steps, you accrue what you think the right answer is, and then you go through an audit and you get a completely different answer? Like what happens, right? So that's a question you should have asked Lee. I don't know if you saw in her rate rack, in one year they had a benefit of like $20 million for resolution with tax authorities, which is basically them saying, we reserved $20 million and they didn't catch us for $20 million and the audit's over. So good for us. And it can work the other way. Right? Sometimes it's, I reserved something, I got audited, it was actually more than I reserved, so there's a charge. And that doesn't mean there's necessarily an error, but in a lot of cases it will mean that there's an expense or a benefit, depending on which side of the reserve you ended up on. What Fin 48 does, and it's because of the first 3 bullets on this slide, it pushes you into a very conservative reserve position relative to what your reality tends to be. So in most situations, companies, like if you polled, the top 100 companies in the Valley and said, you think you're over-reserved or under-reserved, and you looked at kind of what their actual audit experience was to their reserves, the vast majority would be over-reserved. And so usually what you see is settlements with authorities, and then pop, big benefit. That's common. But it doesn't mean there's necessarily an error or you have some kind of prior restatement problem. I mean, sometimes if you just blow it and you miss something factually, that's the case, but that's rare. Of course, the problem with those big pops is if your IRS auditor or whoever the tax authority is sees that right after you settle your audit you just booked a giant provision benefit, they're probably thinking, oh, I guess I missed the issue, right? And I don't know if auditors are reading financial statements like that, but there's a pretty clear connection between I settled and boom, provision benefit. If you grossly underestimate your reserve, it depends. It's such a fact-specific issue, right? I mean, these big public companies that we're looking at, their 10Ks, they're audited by usually big four firms, and those firms aren't usually going to let you grossly underestimate what your reserves are. I mean, most of the, like Lee was saying, most of the high-tech company issues that are creating the UTB amounts that you see in the disclosures, they're pretty well-known issues. And so even though there's a range of what's possible, it's pretty hard to be way off. Way off. Okay. All right, let's keep rolling. Right.
So how do you get the 20%? Because I know I'll get like 180 or 60 or something, but I don't know exactly about the possibility. So how do you evaluate that possibility? Because it's kind of subjective. Sometimes I think you can manipulate the numbers. So
right. Yeah, it's up to your judgment, and it really comes down to whether your judgment seems reasonable, right? And so an auditor can't tell you what your judgment is, but if you said, like on an R&D credit, I think there's a 99% chance I'm keeping the whole credit, the auditor would typically say, well, that's interesting, but 10 out of 10 of my other clients don't do it that way. And, I've been with Deloitte for 20 years, and that's just not how it works, right? I mean, I've seen these things enough to know. So what you bake into your FIN 48 analysis has to pass some sort of smell test. And you'll be bouncing these things off of people that have an expectation of what the range is. That's what it'll come down to. Kuwait?
Wouldn't you also factor in your audit results? So how much you actually got assessed, how much for example, the R&D, what your assessment was, and how much they reduced it, and compared to, kind of like get a percentage from that.
Yeah, that's right. That's right. I mean, I think in most cases, companies are trying to do the right thing and not manipulating numbers. So, I mean, that's kind of the exception. It's easy to call that out in this, kind of lecture format because you see how kind of silly the mechanics are, and it seems very susceptible to abuse if you wanted to change the numbers. But in reality, I mean, people usually have a table of 3 rows, and it's kind of a win, settle, lose. And usually the probability of settling is high. And so you end up with that settlement scenario as your likely, your cumulative more than 50% scenario. And then it's up to you to define what that settlement number is. Right? Most people are trying to kind of nail that with as much precision as they can. I mean, that's typical. Okay, I'm going to keep rolling and go quickly here. I'm going to get to our examples. Okay, so I blew through a lot of stuff on the slides, and you can go back and read some of that in terms of how the accounting works and the classification. There's a couple more points I want to get to before we hit our first problem here. The first is, once you accrue a reserve, it's always subject to remeasurement if it's a reserve on a position that you've passed the recognition test for. So take that R&D credit example. If you booked a 60 benefit and a 40 reserve, and later, you're talking to all your peer companies, and they're like, man, I'm winning all my credits, right? Like the IRS is super easy, and you kind of see what the behavior of the tax authority is, and you decide, man, I think my 40 reserve, it's way too conservative. You can change it. You can say, I think I'd probably go back up to that 80 scenario based on what I'm hearing. right? And so what FIN 48 basically says is you know, as you get new information, you remeasure. And the rules seem like you can remeasure frequently, right? Like you're in the second quarter, you get some new information about how this issue is being addressed. You can bake that into your measurement and come up with a conclusion. Go to Q3, you can get to a different conclusion. Go to Q4, you can get to a different conclusion. That's kind of how the rules read. In reality, very, very rarely do people remeasure their positions. So it's kind of I set my accruals, I stick with them unless something absolutely major happens, and then I settle up with the tax authority and I clean up my balance sheet at that point. That's typical. Okay. The problem with new information and remeasuring is it becomes so subjective that you start setting yourself up for, well, why did you measure for this and not for that? And what's significant enough to move the dial on Q2 versus Q3? And it just gets very difficult. So most companies say that new information has to be really significant before they make a change to their reserves. The last two bullets on this slide deal with effective settlement. So this is a tricky issue in that, you know, let's say you go through an audit and the agent just misses the issue, right? This happens all the time. So you take a deduction, maybe you shouldn't have taken the deduction, you get audited, the audit's over, the issue was never raised, you get your paperwork, your revenue agent report, and then off you go, the agent's happy, you're happy, it's done. And let's say that you still have 2 years of statute on that tax year. So in theory, the legal liability still exists, right? The IRS could always come back and audit you again, find the issue, and assess you. But that never happens, right? And so the second bullet basically says, you know, you don't have to legally extinguish a liability in order to recognize the benefit of the position. And this concept of effective settlement is described in the third bullet. And so it basically says if a tax authority has completed their audit, you're not appealing or making kind of a mess of the issue that's going to irritate the auditor or make them want to audit you more. Just basically my words for the second bullet. And the third bullet is it's remote that the authority would come back and re-audit you. If all three of those things are true, then you can reverse your reserves even before the legal liability has lapsed and even though the agent hasn't actually addressed the issue. So that's a pretty common scenario when audits closed, although those tend to be for the smaller issues. I mean, if most reserves are for R&D and transfer pricing, those things don't get missed. Everyone has them, and all the tax authorities know it. And so this tends to be the fringe issues. Okay, the last thing I want to cover on this topic is, I think it was 2 years ago. I think we just finished a corporate filing season that had the second version of these forms. So the IRS, again, FIN 48 came out in 2007. That's when companies had to adopt. And then the IRS started looking at this and saying, hey, this is pretty neat, right? If companies are accruing all these reserves and they're keeping track of all this stuff that FIN 48 requires them to track, we should have these companies put a form in their tax return that tells us when they accrued reserves. Because we know they have all the information, right? And so let's have them share with us. And that's going to make our audits so much more efficient because we don't have to go find the issues. We can just have them tell us what the issues are, and then we'll audit them and we'll be quick about it. Right? And so, so the IRS came out with this form, Schedule UTP. And like I was saying, I think the last year, the 2011 calendar year for corporations was the first year that Schedule UTP was required. And this year, that 2012, that was just filed a few weeks ago, was the second year. So now, anytime a company accrues a reserve in their GAAP financial statements, and they meet the requirements for having to file this form, which is this kind of asset threshold you see in the middle of the page, which is really low, you have to then file the Schedule UTP with your tax return and share a bunch of information with the IRS about the tax items that you've reserved for. And as you can imagine, companies are not happy about this, right? So there's two types of reserves that go on the Schedule UTP. The first is, or two types of positions that go on a Schedule UTP. The first is a reserve in your audited financial statements. So if you book a reserve for R&D credits, you fill out the form, you put, I took a position under Section 41 of the Code, which covers R&D credits. You check a box as to whether it's a permanent issue or a temporary issue. So a credit would be permanent, so you check permanent. And then for positions that are more than 10% of your total reserves, you have to check another box that says it's a major position. And then you have to rank your reserves from biggest to smallest. You don't have to put the dollar amount that you reserve, but if R&D credit was your biggest reserve, you put that at the top of the schedule. Okay? So now an IRS agent will pick up the form, they'll see Section 41, they'll know that's R&D credit, they'll look and say, okay, you check the box, it's a major position, it's the top of your form, probably going to want to look at R&D credit. Right? And in the statement detail to the form, you have to put a description of what the position is that caused you to think there was exposure. So you're supposed to write a little paragraph that says, you know, I included the CEO salary, and maybe that's not going to pass, you know, muster at the end of the day, and so I reserve something on my R&D credit. And that's not what people really say, but that's kind of the idea behind the white paper detail. Okay. All right. So what do you think that filling out that form, that Schedule UTP form, how do you think that's affected companies' tax provisions? It's not a trick question. They become conservative, you think? Well, so if you're Lee and you do something on your, you have a position on the, let's say it's on your, you know, let's say that you're taking a position on some transfer pricing issue, or let's say it's an acquisition, something really specific, right? You buy a company, you take a deduction for some aspect of that acquisition that maybe you shouldn't have deducted. Okay? So if you reserve for that, you're automatically going to fill out the Schedule UTP and say, I did this acquisition, I took this deduction, maybe I shouldn't have taken that deduction. And then, boom, tax authority's going to be like, I heard you did this acquisition, and you took this position, and maybe you shouldn't have. And you're going to be like, ah, right? And maybe it would have been a really hard issue to spot. And so now, by filling out that form, you've totally changed the environment on how you might ultimately handle your tax controversy down the road, right? And so companies are now thinking differently about, A, whether to take the position in the first place, which I know is the IRS's preferred way of you thinking about that, or not booking a reserve, right? And so now maybe you look and you say, you know what, I think I'm going to win, right? I don't think I need a reserve. And no reserve, no form, no problem, right? And so, but of course, that's not the way the FASB wants you to think about this. They don't want you not booking reserves when a reserve might be prudent, just so you don't have to file the form. And again, I mean, most cases people are trying to do the right thing, but this absolutely factors into tax BP's decision making about which deductions to claim, which reserves to book. This comes up all the time in my practice. And so, you know, we'll be talking with a company about a position, and you know, the company will be like, oh, we'll just reserve some of it. And I'm like, hey, look, you know, you reserve, you file the form, we got a whole other discussion. They're like, oh yeah, I forgot. And by now, the form's been around long enough where now that's kind of programmed in people's heads that they automatically think reserves means form. You know, what do I think about that? And so it's just a new reality that companies are in these days, that the GAAP accounting drives disclosures of exposures not only in the 10K, but now in the tax returns as well. I mean, it's incredibly transparent compared to what it was half a dozen years ago. Okay, so that's the whole bit on uncertain tax positions. Okay, so as we look at companies' tax footnotes, you know, for next week's class and the rest of the course, make sure you look at their tax footnotes for unrecognized tax benefits. Read the disclosures. See what they say about their reserves. almost everything that they say in there is part of the disclosure requirements. And if in your reading you saw what those disclosure requirements are, they're pretty voluminous and they're very specific. So you'll see the same sort of things disclosed in each company's 10K, and the companies do it grudgingly. I mean, they don't want to say all that stuff. But it's funny if you went and you know what's the reading for next week? The 10K, do you remember? Intuit. I mean, if you took Intuit's 10K for the year that just ended July, and then take it for 7 or 8 years ago, go back and get an old one from the archives, pre-Fin 48, pre-07, it will look nothing alike. I mean, it will absolutely look like night and day, two different companies. And that's all because of the new Fin 48 requirements. Okay? Okay, so we are going to spend some time doing in-class exercise number 1. And let's just flip to it and go through the facts. I don't actually think we have any reserve issues in this one. We have reserve issues in the next one. Okay, so in-class exercise 1. So we have a company that has $1 million of income. They haven't recorded any tax expense, so all that means is that the $1 million of income is our pre-tax income too. The company's inventory reserve increased during the year by 80 grand. Their book depreciation exceeded their tax depreciation by 20,000. They had 50,000 of tax-exempt income. They claim an R&D credit of 10,000. Assume that that R&D credit is a reduced credit. Some of you will ask. So if you don't know what that means, don't worry about it. If you know what that means, then we're claiming a reduced credit. Okay? If you don't even know what I'm talking about, just assume we get $10,000 off our tax bill because we did something good. Yeah? Hopefully that makes sense. Okay, assume our tax rate is 35%. That's the federal rate. We operate in 2 states. State 1 has an apportionment rate of 80% and a tax rate of 5%. State 2 has an apportionment rate of 30% and a rate of 10%. Okay. So, don't they have to add up to 100%? I don't know, Eugene, what do you think? You're our state guy.
When I was at FTE was 3 factors.
When Eugene was at the FTB, they apportioned income based on 4 factors. So now how many factors does California use? 1.
So, at
Okay.
first, like alternative, they can do
Right.
1 or...
You've already answered the question, though, which is all the states don't use the same apportionment scheme. So if one state's apportioning your income based on property, payroll, and sales, and another state's just using sales, you're going to come out a winner or a loser, depending on how your relative property, payroll, and sales falls into the various states. So sometimes that apportionment will come up adding up to more than 100, and sometimes it'll be less. And if you were really good with your planning, hopefully it's a lot less than 100. But all the states have kind of figured out this game, so they're all changing the rules to try to get their number as high as possible. So it's not uncommon you're over 100 these days. Okay? Okay, so for those of you who are not familiar with state income tax returns, all you got to think about is that the state 1 is going to take 80% of your income and make it taxable in that state at a rate of 5%. And state 2 is going to take 30% of your income and tax it at a rate of 10%. Okay, so when we were talking before about state taxes, I think it was in the last class briefly, I mentioned that if you pay $1 of state tax, you get $1 of federal deduction. Right? So that means if we paid $1 of state tax, we save 35 cents on our federal tax bill. So net, we pay 65 cents in tax on that profit, right? So if we're doing our provision jurisdiction by jurisdiction, these are 3 different jurisdictions, right? Federal's 1, state 1 is 1, state 2 is 1. Okay? because you get a federal deduction for state tax, you should do your state tax provisions first, and then do your federal provision. Okay? You should do state 1's provision, then do state 2's provision, then do federal, and assume that the federal deduction you get for your state taxes is this year's state taxes. Meaning, assume that you get a federal deduction this year for the state taxes you pay this year on an accrual basis. So don't worry about when you pay the taxes or any of that. Just, if this is calendar 2012, let's say, if we had a $10 state liability in calendar 2012, we get a federal deduction for calendar 2012 of $10. Okay, we're on a current deduction basis. Okay? All right, so the questions that are in the exercise are kind of the same questions as you saw before, but really at the end of the day, I want you to figure out how to do the whole provision. I would recommend you do it jurisdiction by jurisdiction. Do not try to like all aggregate it and do it quick. And then when you're done, do a rate rec for the whole thing. Okay, so we learned how to do rate recs in the last class. Okay, so here, this problem is much more difficult than last week's problems. So without a doubt, work with a neighbor or two neighbors, that's fine, and figure it out together. Okay? All right, off you go.